All right, hey again, guys. I just wanted to make another. This one's gonna be fairly short, but to talk about why things like candlestick patterns and a lot of technical analysis doesn't work. Because I'm sure you've all tried technical analysis by now, and I'm sure you've also found out to your dismay that it didn't give you much confidence in trading. You could try trend lines, you could try a candlestick patterns, you could try this or that. Um, The issue is that none of those things actually work. And the reason, and I can very simply explain to you and briefly explain to you why that's the case. And the first step to explaining that is, well, what is a candlestick? A candlestick is just a set of data. It's just it's an amalgamation of price grouped up into sections of time. So if you're on a 5 minute chart, each candle is 5 minutes of price action, right? Except first off, it's not really 5 minutes of price action because all you see are the open, high, low, and close. You don't know if it hit the high first or the low first. You don't know what it did between the open, high, low, and close. So obviously, the smaller time frame for your candlestick, the more accurate it's going to be as a representation of what price did. The bigger the time frame, the less descriptive it is about what occurred during that time frame. You could be on a 1 hour candlestick and it could be a giant, very big green candle, but you don't know if it opened, traded sideways for 45 minutes, and then the last 15 minutes of that candle, it went up and then closed near the top. Or if it slowly grinded its way up there during the whole hour, right? So candlesticks themselves are not very useful in terms of having an accurate impression of exactly what price did. It's more of a general, it gives you kind of a general idea that, oh, price ultimately went up over this time period or price ultimately went down, but it doesn't show you how it got there. And so the problem with candlesticks is because they're time-based amalgamations and not just the fact that you don't know exactly how it got there during that time, like I just said, but also you don't know if the candlestick itself means anything. You are choosing, when you make a 5 minute chart, you are choosing to break price up into 5 minute segments. Okay, but the market itself, if the market had a perspective, okay, let's try to look at things from the perspective of a non-living thing, which is the market. It's just data. But if the market could see what price was doing, it wouldn't be breaking price down into time-based chunks. It would just be one continuous thing where, I mean, unless the market's closed, it's closed. But if it's open, every single moment, not even moment, it's not about the time, it's about the price. Every single time that price moves, it would see that. It would be literally looking at it more of like a tick-based chart of every single order that goes through. So it would see every single fluctuation in price. And so candlesticks are just giving you a general peek into what happened, but it's not perfectly descriptive because you don't know how it happened over those time periods. This also is an issue with people like ICT. He teaches something called the volume imbalance, which I used to believe in when I was, watching his stuff. And those things aren't real because these alleged imbalances are caused by price jumping at the exact time that one candle closes and the next candle opens. But if that's not actually what's happening, then it doesn't matter because, again, you're just choosing to basically oversimplify price into candlesticks. But the only reason a quote unquote volume imbalance exists is because price made a multi-tick jump right at the end of a minute. If price makes a multi-tick jump during the formation of one of your candles, you're not going to see that gap, right? Do you see what I'm saying? If you don't understand what I'm saying, I apologize that it's too complicated to you for you, sorry, but you will either understand it one day or you will never understand it. I can't explain it more simply than that. Okay, so either you get what I just said or you probably never will. Or maybe one day you will once you know trading better, if you're very new to trading. Okay, but so there's lots of illusions that a candlestick chart can create, like volume imbalances or fair value gaps. Fair value gaps don't mean anything because there's a buyer for every seller and a seller for every buyer. So there's no imbalance. Okay, there's no imbalance in price. Just because it was green, a big green candlestick, doesn't mean that it makes a fair value gap. Because along the way, the whole way that price moved up, it found sellers there. So there's no imbalance. The only quote unquote imbalance is that it ultimately went up during that period more than it went down. But that really, I'm telling you, that doesn't mean much. Okay. So what actually does work in trading then? Well, for me personally, what worked was statistical analysis. So yes, I did use things like time and but I'm not looking at it like that seriously in terms of what a candlestick looks like. Did this candlestick close up? Did this candlestick close down? Yes, I do have a profitable bot that does only enter if the pure previous 1 minute candle closed up instead of closed down. However, I don't think that is necessarily that important. It just happened to work that way for that bot. But it's for my more profitable bots, they don't look at what a candle, if it's a green or red candle, it looks at statistics, or it doesn't look at the statistics, but I built it based on statistics that I looked at. And that's the only way you're going to find a pattern, right? Because the only way to beat the casino or to beat the market, because this casino is a market, tradable markets, is if you can find a pattern. And the only way to find a pattern that you could exploit is to do statistical analysis to see the pattern occurring in the past over and over again. That's the only way. That's the only way that you're going to be profitable. And the degree of your statistical analysis, how thorough it is, and what you're able to find with your research will determine how much profit you can make. One form of statistical analysis, the simplest form, is to look at a weekly chart of the NASDAQ 100, determine, hey, this thing tends to go up more than it goes down. So when it is going down, I'm going to buy because I know it'll ultimately go higher in the long run. That's still statistical analysis. That is the most simple form of it, and you're not actually typing up or gathering any data. But that's still statistical analysis because you can at least visually discern that, hey, this thing tends to go up in the long run because stock prices are not inflation adjusted, which means that so long as inflation continues, the prices of the top performing companies that have good earnings will not only outpace inflation but also get pumped up by inflation. So they'll get pumped up, 3% annually at a rate of 3% on automatically if they're decent performing companies. And then on top of that, their earnings growth tacked on top of that will make them grow faster than inflation. And the so but you need the stats. You need the stats in order to determine what is going on in any asset, right? Like, is Monday or should you not buy on Tuesdays? You would need statistics to tell you that buying on Tuesdays, if you're day trading and it actually loses money in the long run, then you wouldn't trade on Tuesdays. I'm just throwing that out there as like a random example, but that's still a form of statistical analysis. Now it can get much more detailed than that, and it probably should, and it did for me, but I'm not going to get into that. But that's the only way you're going to find a pattern. You're not going to find a pattern by creating an optical illusion with candlesticks and then trying to derive meaning from these things that aren't inherently there, if that makes any sense. Okay, because candlestick charts, I'm reiterating this, they are a visual representation. It's a method of visually representing what occurred. However, you are not seeing, they don't show you the exact moment by moment fluctuations in price. Maybe you don't need that, but when you are trying to find an edge in a market where lots of actually wealthy people have lots of resources to try to find an edge as well, you probably are going to want to be able to get as close as you can to seeing every single fucking fluctuation in price. Okay, and I'll tell you this. All of my profitable bots trade on a 1 minute chart. Okay, and I'm not saying 1 minute charts are magical. What I'm saying is that you've got to be that low on the time frames in order to really make it work. Now that said, they also look at hourly charts at the same time. So my bots look at the 1 minute chart, but it also looks at the hourly chart for the same asset to determine some general strength. And again, it's not because it's an hourly chart. That's just because that's the way that I had to look at the data to process the data. I had to use time-based charts. I probably would have a higher profit factor if in NinjaTrader you could back test further than 1 year with a tick chart, but unfortunately you can't. Okay, so but fortunately a 1 minute chart, you know, usually not that much happens in 1 minute, so it's still going to be pretty fractally accurate. But if you go to a 2 minute, 3 minute, 5 minute chart, it's going to get less and less clear what's going on, and the same conditions across days when you're looking at a 5 minute chart might not actually be the same conditions, if you know what I'm saying. Meaning, like, if your trade criteria has some indicator and it's like, if the 5 minute chart is doing this, then enter the trade. And then on another day, it's going to do the same thing if the 5 minute chart's doing the same thing. But if you zoomed in and looked at the tick chart for those days, the price action would actually probably be different. It wouldn't actually look the same. You might think that it looks the same because the 5 minute chart, it's like a green bull candle that is moving a certain amount of ticks or whatever. Um, but if you looked at the tick chart, those 5 minute candles that look the same on a 5 minute chart, you're going to see it gets there differently every time, right? It's not going to be price moving exactly the same with the exact same fluctuations every single second. It's not going to be like that. Okay, so anyway, I kind of rambled and went in circles about it, but it's really important that you understand that the time-based candlestick charts are not completely accurate, and you can make profitable strategies with them, but it's very important that you understand that they aren't perfect. They're an imperfect um, amalgamation of price into time-based chunks. Okay, but who created the rule that the time-based chunks have to be that, right? They don't have to be that. So that's why you have to understand it's just a general gist of what's going on. It's not completely, I wouldn't say accurate because it is showing you the open, high, low, close, but it's just you're determining when the open and close of that candle is based on the amalgamation time frame that you're using. Okay, it's not some objective, oh, the market must obey a 5 minute candlestick chart pattern. Look, if some big whale sells randomly, you're not going to see that coming because the only person who knows they're going to sell is that person right before they press the button on their mouse. And that person is not required to follow any rule or pattern. They can sell whenever the fuck they want to, and they can buy whenever the fuck they want to. And so the only way you're going to be beating these whales who move price is if you find inefficiencies in price action that you can extract money from. You have to find their mistakes in order to make money, and you're not going to find it easily on a candlestick chart. So anyway, that's all for today, guys. Take care.